So the Bank of Canada meeting is today. While I shot this video before the rate announcement happened, I shot this one day before. I already know what the result is because everything is indicating towards that they are going to hold the prime rate. They are going to hold the overnight rates. Why? Because like I've been saying in many videos that 4%, the rates are around 4%, whether you take variable or fixed. If you're taking a 3-year fix, it will be around 4.1, sometimes 3.99. And if you're taking a variable rate, it will be prime minus 0.8, prime minus 0.85. That again lands around 4.1, 4.2% range. These are for insured mortgages. And I've been saying for many, for quite a while, I think a couple of months, more than a couple of months, that 4% is the new normal. Inflation number came in a few weeks ago and they are at 3%. It's higher than what they expected, and Bank of Canada wants to maintain an inflation number of between 2 to 3%. They keep saying 2%, but I think 2.5, 3% is where they want to be, but we are nowhere close to that right now. And contrary to popular belief, I don't think Bank of Canada is going to reduce rates anytime soon. The question is, will they increase the rates instead of cutting them? I don't know, but we are in an economic downturn, and in an economic downturn, if you increase the rates, it actually puts downward pressure on the economy, which gets worse. So Bank of Canada is again at the crossroads of an impossible decision, and I don't see them reducing rates, but I also don't see them increasing rates anytime soon. But this video is not about this because it's obvious the rates are not going anywhere. In fact, in this video, I want to explain why the rates in fact are going up. The fixed rates have gone up by an entire 0.3, 0.4, in some cases 0.5% in the last couple of weeks. And I want the audience to be educated on how the rates move. We'll first talk about variable rates because, let's be honest, it's an easier thing to explain. And then we'll talk about the fixed rates which move with the bond yields, and they are slightly more complicated to understand, but by the end of this video, everyone would be able to read into the fixed rates and what they are going to be in the next week or so. You all have seen the news. This is from last month when they held the interest rates. Similar news would be coming out today as well. But Bank of Canada holds interest rate at 2.75%. Does that mean that the rate is 2.75? No, because we are getting 4% rates. Now, how does these rates translate into what we get at the bank when we buy a home? There's something called as a key interest rate that's at 2.75. That's also called the benchmark rate, overnight rate, policy interest rate. Different names, it means the same thing. Is the interest rate at which banks can borrow when they fall short of their required reserves. And they always fall short of their required reserves because they are running on debt. If we were all to go to the bank and do a bank run, they would go almost bankrupt, right? So even the banks are borrowing money, and that's the rate that they borrow the money at. Prime rate, which we see, prime minus 0.8, prime minus 0.9, prime minus 1, we hear prime a lot. Prime rate is slightly different. It's a 2.2% gap. It can be lower, it can be higher, but usually it's a 2.2% gap between prime and key interest rate. So you'll see 2.75 plus 2.2. And this covers their costs and margins because banks are here to make money. They never lose money. And this gap that you see between prime and key interest rate is their margin. Obviously, they picked up the money at 2.75. They are lending you at prime, so to say, the prime is 4.95, but that's not, at the rate that they are lending you on. They are lending you a variable rate at a prime minus discount, and that prime minus discount is, let's say, 0.85%, and that's where 4.95 minus 0.85 comes to 4.1, and bank offers their 5-year variable rate at a discount of prime to compete with other lenders. That's where competition comes into play. I don't know what would happen if there was only one bank in Canada. I'm pretty sure it will be close to prime, but because we have multiple lenders, they're all fighting for your business, and therefore they have a discount, and most of the banks have the same discount. So rates is not up for discussion. Honestly, rates are almost the same across banks. So yeah, it's just the overall terms that we need to look at. I've made this video as well several times, but I hope I was able to explain how what the difference is between what you see on the news versus what you get at the bank when you buy a home. The question is, how do variable rates move? And it's quite simple. If the overnight rates are cut by Bank of Canada, let's say the 2.75 was not at 2.75 today, it was at, let's say, 2.5%, everything will go down by 0.25%. Now, Bank of Canada is essentially what they're doing is they're trying to balance inflation with the borrowing rates. And it's not just about the interest rates that we take when we are buying homes, it's also the interest rates that they lend on, because prime rates are, when you lend to a business, it's also based off of prime. So a lot of businesses operate on debt, a lot of businesses are operating on credit, and that is also very much dependent on what the decision is today. And whenever Bank of Canada, increases or reduces, it impacts them heavily. In fact, our jobs are impacted by that, because let's say Bank of Canada comes in, and we saw that when the inflation was at 7-8%, Bank of Canada comes in and says that, the key interest rate will be, let's say, 2% higher, 4.75%. Now, the businesses will be able to lend money at 2% higher. That's a massive hit to their bottom line, their profits, and those profits are taken from the jobs. They cut jobs. That comes next, because they have to, somehow balance their profits. Plus, when inflation is high, people are also buying less, the disposable income is less, and it just goes into that spiral that eventually leads into a recession, right? So that's how variable rates are more. So they are just trying to make a very thin balance between inflation and the borrowing rates, and they can't reduce the borrowing rates too much, because what happens then is that people get more disposable income, and then they go into the market and they buy too much, and that leads to inflation again, which is exactly what happened during COVID, when a lot of money was printed, the interest rates were down, everyone started buying everything, including homes, and we saw what happened in 2022 in the housing market as well. So they are trying to balance this, and which is why they are at a crossroads right now, and it's a very difficult one, because they can't cut interest rates right now, and they can't increase interest rates as well, because we are already in a recession. So we're still trying to balance inflation, and inflation is at 3%. So therefore, we are here doing this video where I'm saying that interest rates are going up. Now the question is, if the variable rates actually go up and down, does it also mean that the fixed rates also go up and down? And is it that when variable rates go up, let's say, only then the fixed rates go up? The answer is no, because variable rates, like I said, are driven by Bank of Canada, and they're trying to balance inflation. However, fixed rates are not driven by that. Fixed rates are driven by the market sentiment. What do I mean by that? Now, on the left side, you'll see a select bond yield curve. This is a 10-year, treasury bond. You can just search for a 10-year bond yield, in Canada, and you'll see this curve. And every time these fluctuations happen, the fixed rates can actually go up and down. How this happens is that, and first let me explain what a, like a treasury bill, or what it means to invest in bonds. Bond is essentially like you invest in Tesla stock, very simplistically speaking, you invest in stocks. You can also invest in the government. When you invest in the government, let's say you are not happy with the market returns, or there's a lot of uncertainty, or a bank has crashed, stuff like that happens. You would see that the government bond, the government bonds become more in demand. When they become more in demand, their yields, the return that they give, drops, because there's so much demand that, the yield actually drops, because the bond price is now increased because of all the demand. When that yield drops, the fixed rates also drop. Let me give you an example. And it's all is determined by who do investors trust more. For example, in COVID, the government won. Why? Because people were so uncertain about what would happen. Businesses were going down. There were so many businesses that were shutting down. People were not having Starbucks, and Starbucks stock took a plunge. Everything took a plunge, right? They wanted to go towards a safety. And when I mean they, it's not you and me. It's institutional investors, it's RRSP money, it's like billions of dollars being invested every single day. And all that money started going into the government bonds, because that was the only sure thing. When that happened, there was so much demand for the bond, for the government bonds, that the bond yields actually plummeted. And when they plummeted, and you will see that here, the fixed rates went down. That's where we saw 1.5, 1.6, 1.7%, 3-5 year fixed rates. On the other hand, when there's increasing inflation, there's war, there's some political turmoil, when people are not trusting the government, or the markets right now, for instance, are doing really well, what happens is all the money, all the institution money goes from the bond yields into the stock market or into the capital markets. And when that happens, the bond prices actually go down. And when bond prices, the demand for those bonds is reduced, the yields actually go up, because they have to make sure that, let's say a bond is paying 3%, the market is paying 8%. They want to make it lucrative for people to invest in the bonds. I'm just doing a very simplistic example. And that bond yield is now higher. When that bond yield is higher, that's when the fixed rates go up. And right now, even though there's still war, the market is actually doing very, very well. And therefore, you see that the bond yields have consistently increased from March 2025 to July 2025. And that's where we see the fixed rates going up. In fact, in the last, let's say, we are still talking about July, mid-July to now, like the last 15 days, we see that the bond yields have increased by almost like 0.15, 0.2, 0.25%, which is where the fixed rates have also gone up by almost the same amount, sometimes a little bit higher, and which is why you see right now the fixed rates that you get in the market are nowhere close to what we were getting 2 weeks ago. So the next time you want to know where the rates are headed, especially the fixed rates, all you need to do is open the bond yields and see where that's headed, and you'll know whether you'll get a higher interest rate or a lower interest rate. And these rates can change every single day, and they can change drastically if there's a drastic event that happens. I'll give you an example. I still remember mid of 2023, and some of the clients who are watching, they will resonate with this. Mid of 2023, when the Silicon Valley Bank collapsed in the US, obviously it happened in the US, and you would say that why would it have an impact in Canada? Because in general, the sentiment was that the bank has collapsed and maybe there are other banks that will collapse. And therefore, the markets plummeted at that time. Everything went towards the bond market because that's safer, and that led to the yields going down. Like I remember 5 to 6 days was all we had to get all of our 23 clients that were active at that time. We applied for a lower rate for them, and we got like 0.5 to 0.6% lower. We were at 5.1% for all our clients because the fixed rates were at that level. All of them got anywhere between 4.3 to 4.6 depending on their file, and that is just a 6-day window that we had. That's the beauty of mortgages. Let's say you buy a home right now and you lock in a 3-year fixed and you have 2 months to closing. What we can do is that if the rates go up, that's fine. You already got a lower rate because we actually locked it in. We have the commitment for that. However, if the rates, something in the market happens and the rates actually go down a lot, you can actually get a lower rate. So you do not lose if something happens while you are making the purchase. Obviously, if it happens after you have closed the home, we can't do anything about that. But if it happens before the home, like even the last day, I still remember during the Silicon Valley collapse, there were files that were closing on the same day, and we were able to get those rates also reduced. Obviously, it depends on how nimble you are or whoever you're working with, they are glued on the market or not. But we were able to get that. So just like a side note, if ever you find yourself in a situation where you're in between a closing and there's a massive event in the market that happens, make sure you check with your mortgage agent or you check your bond deals and make sure that you get the low rate. In this video, I'll just clarify one thing. A lot of people are asking whether to go for a variable rate or a fixed rate right now. In my view, if you're buying your primary home, go with the fixed rate. A 3-year fixed rate is the best way to go for most people, unless you are making a change in the next 3 years or you're buying a flipping property like a flip or which I would not recommend right now. But for any reason, if you want to break the mortgage in the next 3 years, then maybe go for a variable. It's case by case. But for most people right now, especially if you're buying your own home and holding for 3 years at least, I would go for a fixed rate right now because first of all, both the rates are almost the same. And second of all, we don't know where the market is headed, and just go towards the safety of fixed so that you know that there's a definite payment that's going out of your bank account and you know exactly what you're getting yourself into. That's all I have for today. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय.